Over the last 5 years, it turns out the best asset allocation decision would have been to invest in an aggressive portfolio. But is that still the case? Our chief equity strategist and economist, John Blank, is here to tell us. John, we're talking according to the data you've assembled from pre-COVID 2019 through the solid returns of 2023, with the best year in that time span being 2021. So how much of an aggressive investment are we talking about, and what would be the return on that money? What would that have been?
Yeah, so Terry, I would be looking for growth stocks, not value stocks, and I would look for a return, on about 15% a year. If you did a growth stock index and stayed focused on growth stocks across, small, mid, and large, and mostly U.S. And what I would tell you, Terry, is in an election year, when you have a January effect, the January returns of the S&P 500 are positive, and it's an election year of an incumbent, the typical return is 15%. So it is probably the right answer to stay aggressive with stocks and, focus on a large concentration of stocks for this year.
But those years, 2019 through 23, they were not without risks totally, right?
That's correct. 2022 was a big negative year because of the rate hiking. So that was a year that you actually lost out on the aggressive positioning. But if you were buying stocks through your 401k or your Roth, your IRA, this was a great time to get lower prices. Now they come back. So you got to stay with the, at least a market weight allocation to stocks. And generally speaking, you got to believe that the returns at the 14% level are going to be 4 to 5% higher than what you get out of a high yield bond.
So you're saying that beginning with this year, 2024, it's still good to stay aggressive in your portfolio for a good return, even in light of all the looming and seemingly increasing geopolitical risks out there?
Well, the geopolitical risks, are keeping a lid on returns in China, which may be, a contrarian pick, but in general, the rest of the markets out there, Japan and the Western Europe, are at record highs, just like the United States. And frankly, for the same reasons, big concentrated positions in major stocks. Like, for example, in Japan, I was doing consumer discretionary stocks, and a lot of the major stocks that are super big and super inflated are Japanese consumer discretionary stocks.
So is it wise then for investors to just focus on geopolitical risk when making investment decisions this year?
I think geopolitical risks have to be ignored, Terry, from an asset allocation perspective. It doesn't ever seem to be the case that it matters. It did matter for foreign direct investment into China, which took Chinese stocks down, but you have no idea how that can bounce now that it's lower. Just like 2022 now can be a good time to buy Chinese stocks, not a bad time. And this is the problem here is markets, as you and I know, are very forward looking.
Yeah. What other risks out there should investors be aware of?
I think the big risk right now is geopolitics. It is a spreading ability for a place like China, now the number 2 world's largest, second largest economy. 20 years ago, wasn't even in the WTO. Now you've got a situation where if they get involved in this Russian thing with the North Koreans and the Iranians, we're in a big situation that nobody's really thought through. And I think that's what we got to pay attention to.
So that risk and maybe others not even known right now, all these risks going to make for a noisy and cloudy 2024?
No, I don't think so. I think, generally all these risks have been priced in. It would be something that would be more on the lines of escalation of these risks to a level and magnitude that nobody foresees.
Does the chance of interest rate cuts this year remain a market focus?
Well, the market thinks there's going to get 3 or 4, like, the Fed is telling them, and has been telling them from June on, 4 meetings through the end of the year over those 6 months, 3 to 4 meetings over those 6 months. And I think that's appropriate now.
Last year, bond market volatility was a consistent concern for the market. What about this year?
I would say that, we're at a, basically a 4.3, 4.2% 10-year rate. which, if you think about the short end, the Fed funds rate at 5.33, there you have your 1% for 25 basis point cuts already priced in. So I don't think anything additional to that is being priced in, so I don't see more volatility.
More recently here, NVIDIA seems to be getting all the credit for this stock market rally that we've been seeing lately. Does that kind of cement AI's financial promise going forward?
Well, going forward, Terry, is a different story. I mean, it might now be completely priced in. That's the problem here is everything's been priced in on NVIDIA and then some. So a lot of profit taking can take place here in March because people are betting, have bet so strong. There's nothing more to bet on in terms of NVIDIA, and that's the problem here.
All right, 3 very large cap growth stocks made it into the number one list here this past week, hailing from 3 different industries, no less. 2 of the 3 are tech-related: Cadence Design Systems, Crowdstrike, and HCA Healthcare.
Yeah, Cadence Design Systems is a fantastic stock. People should know about it. What they do is you go to them and with your project, and they basically come up with a version of your system. So, for example, putting it, or something on a chip for when people go to get ultrasounds for birthing, you can put that all on a chip now and have it portable. So Cadence Design Systems is the number 1 ranked stock. It does have an F for value. You got to keep that in mind. But the computer software industry is the top 23% industry. You're going to pay up for stocks like this. This is a $300 stock now, Terry.
All right. And then CrowdStrike.
Yeah, CRWD. CrowdStrike is in this space where I think it's a security business, Terry. And you got to love security business. So you got a number 1 rank, but again, an F for value. This stock is in Sunnyvale, and this is what they say on their website: endpoint protection, threat intelligence, and cyber attack response. So anybody who is in this business, we're talking NVIDIA, we're talking cloud, we're talking remote working, all of this has increased cybersecurity threats and people's, phishing and all this corruption. So you got to love ticker CRWD, but once again, you're looking at $325 stocks, so you got to wonder what the F for value is all priced in and it gets sold off from here.
And HCA Healthcare.
HCA Healthcare. Now, this is actually, like we talked about, a very different business, but it's a number 1 ranked stock with an A for value, not an F, an A for growth, and that gives us a much different feeling. And of course, interestingly enough, it is another $300 stock that's $310. So, but you got to like a stock like this because you get a forward P of 15 and a PEG ratio of 1.6. So this is actually one where there might be some value. So this is what happens here. People can sell CrowdStrike and Cadence Design and move into an HCA Healthcare, and that would be a very good rotation. So that was what we might see in 2024 as this rally broadens out.
All right, our chief equity strategist and economist, John Blank, on stock market strategy and market risk. With John, I'm Terry Ruffalo. Here's something to check out: Zacks 7 best stocks for the next 30 days. A just released special report that names those tickers can be yours for only $1. Go to Zacks.com/promo for details.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.